One of the most persistent myths in personal finance is that owning a home is financially superior to renting. There are good reasons to choose either renting or owning, but purely based on the numbers, there's not a clear winner on expectation. This matters because it means that people should focus on aspects of the decision that are important to them rather than feeling financial pressure to buy a place as soon as possible. Canadian housing costs have increased a lot over the last 20 years. That fact leads people to believe that buying a place to live in Canada must have been far superior to renting and investing in stocks over that period. That belief is wrong. I've assembled 20 years of detailed Canadian data to compare the analytical wealth outcomes of renting and owning for the 20 years ending December 2024. The results will blow your mind. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to show you with real numbers that renting a place to live has not been a bad financial decision in Canada for the last 20 years. In past videos, I have shown that renting and owning are financially comparable based on projections built on assumptions about things like property tax rates, the rate of return on real estate and stocks, and inflation. I think those projections and their underlying assumptions are reasonable, but they're not reality. In this video, I'm going to use actual historical data for 12 Canadian cities to show the same thing. I'll be honest, I was surprised by the results. I was expecting renting to look terrible, and it actually looks great. Before you tell me I'm wrong, please watch the video. I will walk through my data, assumptions, and results in detail. There's a narrative that renting has been a mistake in Canada in recent history due to rising property values. But as you'll see, the results across the country have been mixed, both by geography and by time period, with renting making a very strong showing most of the time, even in cities like Toronto. I used data for apartments due to data quality and availability for the 20 years ending December 2024. I looked at that full period and the 4 non-overlapping 5-year sub-periods for each city. In 7 of the 12 cities, the renter accumulates more wealth than the owner over the full period, and the renter comes out ahead in 71% of the 48 5-year sub-periods across all cities. That may seem surprising, but one issue that gets missed in this discussion is that while Canadian real estate has been a rocket over this period, so has the stock market. Let me give you some data to set the stage, and then I'll explain my model. The average 20-year annualized return on the price of apartments for the 12 cities in my sample is 5.11%. It was higher in some cities and lower in others. That may not seem like a huge number, but over 20 years, it leads to substantial price appreciation. For example, an average apartment in Toronto cost $198,300 in January 2005 and $602,700 in December 2024. That's an annualized return of 5.74%. Compound growth can accomplish a lot given a long enough time, even with a modest return. Don't get me wrong, that real estate return is pretty good, but a portfolio consisting of 30% Canadian stock index and 70% global stock index returned an annualized 8.62% over the same period. That would have turned $198,300 into more than $1 million. Those numbers don't tell the full story because the renter had to pay rent and the owner had other costs associated with living in and maintaining their home. But these numbers do put the price returns of real estate into perspective. They have been high, but probably not as high as many people imagine when they think about the Canadian real estate market relative to other assets. The highest annualized price return in my sample was Kitchener-Waterloo at 6.99%, followed by Vancouver at 6.45%. Some other cities had much lower appreciation over this period, which points to an interesting observation. There's a ton of dispersion in real estate markets across the country. The last thing I want to mention about the data before I get into describing the rent versus own model is that the end of my sample period saw sharp price declines for some cities while stocks were resilient. Toronto, for example, saw apartment prices fall 21% from March 2022 through December 2024, affecting the rent versus own results. Okay, let me describe the model. In January 2005, you're renting a place to live, paying the average apartment rent in one of the 12 cities in my sample. You've saved up enough cash for a 20% down payment and closing costs based on the average cost of buying an apartment in that city. And you're trying to decide whether you really want to buy a place or keep renting and invest that cash in the stock market. I'm using apartments because the data for single-family home rentals are more sparse, which does speak to one of the reasons that buying can make sense. There aren't a ton of single-family homes available for rent. If that's what you want, renting simply may not be an option. That being said, my last rental before I bought a home was a beautiful detached home in a great part of Ottawa, at a great rental price. So those rentals are out there if you're lucky. Anyway, I'm using apartment data for this analysis due to its availability and quality. Okay, so we're in January 2005, sitting on some cash and deciding whether to keep renting or to buy an apartment. The model tracks the counterfactual outcomes through the net worth of the two scenarios over time. If you keep renting, the cash you had saved up gets invested in stocks, and if you buy, the cash goes toward purchasing the apartment. In the model, the homeowner has enough cash flow to cover the cost of owning, including property taxes, maintenance costs, including condo fees or strata fees, insurance, and the mortgage payment. The mortgage is financed with 20% down and a 25-year mortgage at the prevailing mortgage rate at the time. The renter has the exact same amount of cash flow available, but they typically have lower monthly cash flow costs since they're only paying rent and a lower amount for insurance. The monthly difference between the owner's and the renter's cash flow costs is invested in the renter's portfolio if it's positive and withdrawn from the portfolio if it's negative. Keep in mind, though, that the owner's cash flow costs are much higher than just the mortgage payment. This savings assumption is one of the biggest assumptions in my model, so it's worth spending a minute on. Forced savings is one of the best arguments for buying a home. If you're going to rent and spend instead of rent and save, you're likely better off buying a place to live. Those big mortgage payments contain a significant amount of principal repayment, which is building equity in the home by reducing the amount that you owe. That is a great feature of mortgage debt if you don't trust your ability to be a disciplined saver as a renter. However, a disciplined renter, as we're about to see, has at least an equal opportunity to accumulate wealth. The renter's portfolio in the model consists of 30% Canadian equity and 70% global equity index funds with an annual fee of 0.25%. It's similar to VEQT. In my analysis, rent does increase every year. That's one of the most common questions I get about this type of analysis, based on the historical rent increase in each city. The rent increases over this period are 6.24% per year on average. And I do find that over the full period, owning tends to look better than renting in cities with the fastest rent growth. This makes sense. One of the best financial arguments for owning is that it hedges the cost of living in that specific home. And that hedge did pay off in my analysis. Let's look at Toronto as an example. In January 2005, you're sitting on $43,626 and paying $973 per month in rent. You consider buying a condo worth $198,300, requiring a $39,660 down payment and a loan of $158,640. Mortgage rates at the time are 4.1%, resulting in a mortgage payment of $843 per month. I think right here is where a lot of people get stuck. They see that rent costs more than the mortgage payment and believe that renting is just throwing money away. But the owner also has property tax of $282 per month and maintenance costs, including condo fees, of $324 per month. This leaves $476 per month in additional monthly costs that the owner needs to cover in excess of the cost of renting. Holding available cash flows constant, that monthly amount can be invested by the renter. The monthly savings amount does decrease over time in this Toronto example and even becomes negative by January 2022 as the mortgage payment stays fairly stable over time while rent increases. Rent in 2022 in the model is just under $2,000 per month in Toronto. That seems like it would make the owner come out ahead. But by this point, the renter has an investment portfolio worth $340,000. And the portfolio's return in a typical month far exceeds the difference in cash flow costs, allowing the renter to continue accumulating wealth. This is a good place to dispel another common argument, that renters will always pay the owner's cash flow costs plus a profit margin for the landlord. I'm sorry to tell you, but that's not how a market works. Market rents are not set by landlords based on what their cash flow costs are. It is not uncommon for landlords to be eating monthly cash flow shortfalls on their rentals. Increasing the price of rent only works if people are willing to pay rent at that price, and in a competitive market, that will not always be the case. Okay, for the 12 cities that I looked at, 7 favored renting and 5 favored owning over the full period January 2005 through December 2024, measured by the ending net worth of the renter relative to the owner. The simple average of the ending wealth ratio of renters to owners is 1.17, meaning that renters, on average, had 1.17 times the wealth of owners. To make sure it's clear, when the renter-to-owner wealth ratio is above 1, renters came out ahead, and when it is below 1, owners came out ahead. Owning does look better in places that you would expect, like Vancouver, Kitchener-Waterloo, and Victoria, and in some surprising places like Calgary and Edmonton. Montreal, Ottawa, Winnipeg, Quebec City, Hamilton, and Halifax all favored renters, as did, to my surprise, Toronto. Let's look at each one in a bit of detail quickly. Keep in mind that these charts reflect the effects of both the renters' and owners' housing costs over time. Toronto was a close outcome with an ending wealth ratio of 1.05. Rents and prices increased a lot over the full period, but the cost of renting was not terribly high relative to the cost of owning. The renter and owner had similar wealth with a few lead changes until 2015 when real estate prices took off. But then they came back down after 2022, while the broadly diversified stock portfolio maintained its value. Montreal favored renting for most of the period and had an ending wealth ratio of 1.48. Rent growth and the cost of renting relative to the cost of owning were fairly low over this period, allowing renters to stay ahead. Price growth was also modest for real estate here. Vancouver was rough for renters, to nobody's surprise, over most of the period with an ending wealth ratio of 0.71. Rents were not terribly high relative to the cost of owning, but the high price growth and rapidly rising rents made it difficult for a renter to keep up. Even still, a wealth ratio of 0.71 is probably not as bad as people imagine when they think about renters in Vancouver over the last 20 years. Calgary and Edmonton are two of the most interesting cases. They had very low price returns from most of the sample, but a big jump in prices early on. The result is that the owner comes out way ahead of the renter. Rents were also high relative to the cost of owning, making it difficult for renters to save. Renting does come out ahead in 3 of the 4 5-year sub-periods, but due to that initial price jump, these two cities have the worst rent-to-own wealth ratios in the sample at 0.37 and 0.39. Ottawa is another one that I found surprising. The wealth ratio is 1.97 at the end of the period due to modest price growth for real estate and fairly low rents relative to the cost of owning. Winnipeg had low price returns and fairly high cash flow costs for owners relative to renters, allowing renters to accumulate significantly more wealth, with an ending wealth ratio of 2.93. Quebec City and Hamilton saw mixed results and had multiple lead changes throughout the analysis, but renters came out ahead at the end of the period with wealth ratios of 1.14 and 1.12. Kitchener-Waterloo and Victoria both had strong price returns that allowed owners to stay ahead of renters for most of the sample, with ending wealth ratios of 0.71 and 0.85, and Halifax had multiple lead changes but ultimately favored renters with a finishing wealth ratio of 1.26. That full period analysis is interesting, but I'm guessing that many of you watching didn't buy a place 20 years ago and continue living there until today. To address that, I also looked at the 4 non-overlapping 5-year sub-periods. The sub-periods are modeling the same rent versus own decision I described earlier, except the decision is being made in January 2005, 2010, 2015, and 2020, and then the result is being examined 5 years into the future in each case. There's no magic to the 5-year number, other than it giving me 4 equal-length sub-periods to examine. Moving to sub-periods changed the results quite a bit. While real estate prices increased over the full period, they were relatively flat or even negative over some sub-periods for some cities. The other big difference with the sub-periods is that the cash flow costs of taking out a mortgage at higher prices later in the sample requires higher cash flows from the owner in the model, allowing the renter to save more. For example, owning a place that you bought in 2005 will tend to have lower cash flow costs than renting at today's rent prices, but buying a place today would likely cost more than renting when all cash flow costs are considered. In the 2005 to 2009 sub-period, owning comes out ahead in most cities. Renting only fared better in Montreal, Ottawa, Hamilton, and Halifax. Over the 2010 to 2014 sub-period, renting comes out ahead everywhere, largely due to low real estate price returns over the period, which averaged 2.43% annualized. 2015 to 2019 was mixed, with 5 cities favoring owning, and the 2020 to 2024 period favors renting everywhere except Halifax, largely due to the fact that real estate prices fell in many cities over this period, while the stock market soared. Over all 48 sub-periods across 12 cities, I find that renting comes out ahead 71% of the time. These findings are in line with past research on this topic. For US real estate, the 2012 paper, Lessons from Over 30 Years of Buy versus Rent Decisions, Is the American Dream Always Wise?, finds that over the period 1978 to 2009, renting beats owning 75% of the time for 8-year holding periods, when the renter invests in a portfolio of stocks and bonds matched to the risk of the relevant real estate market. For Canadian real estate, the 2007 paper, Are Renters Being Left Behind?, finds that renter wealth matched or exceeded owner wealth in 7 of the 9 cities studied over the period 1979 to 2006, when the renter invests in a Canadian index fund. I find these data compelling. To be clear, they're not saying that renting is financially superior to owning, though they do seem to show a bit of an edge on average. The data do show that renters have a fair shake at matching the wealth accumulation of owners. That doesn't mean that they actually will match the wealth of owners, because saving and investing can be behaviorally challenging. But it seems overly paternalistic to me to turn that into a prescription that everyone must buy a home. If someone is confident in their ability to save and invest while renting, it's not necessarily true that they are at a financial disadvantage relative to an owner. These data support that. Okay, this next bit is going to get nerdy. I'm going to walk through my assumptions and data sources in more detail. I will also go through some sensitivity analysis to show how things like high investment fees and a lack of discipline in saving can affect outcomes. Data for rents in the model are from the CMHC Rental Market Survey. The data are updated as of October of each year. I match the October survey data to each respective year in the model, meaning that, for example, January 2005 rents are based on the October 2005 rental survey data. Survey rents represent the weighted average of both vacant and occupied units. I use a unit-weighted average of primary and secondary market rents to come up with a rental cost assumption in each market. The renter in the model invests an initial lump sum and then saves or withdraws the difference between their cash flow costs and the owner's costs into an investment portfolio. The gross of fees return on the renter's portfolio over the full sample period is 8.62%, and I net out a 0.25% fee. The portfolio in the model is not taxed, representative of the renter using FHSA, RRSP, and TFSA accounts as they became available throughout the sample period. Based on the amounts being saved, I think it would be feasible for the renter to use their registered accounts for the full simulation. If we did introduce taxes on investments, it would make owning a home increasingly attractive at increasing personal income tax rates. The tax-free growth of the primary residence is a major advantage for Canadians who have maxed out their registered accounts. Home price data come from the MLS Home Price Index apartment benchmark for each city. These data do not reflect any repair, renovation, or maintenance spending from homeowners that contributes to index returns. I account for these in the model by applying 1% depreciation to the index annually and having the owner spend 1/3 of the renter's rent payment on maintenance and repairs. I tested this maintenance cost assumption against the actual cost of current condo fees in each market, a cost that forms a big part of maintenance spending for a condo, and found that the numbers match up really well. Maintenance and depreciation is a big assumption and often a point of contention in this type of analysis, so let me provide some additional color. To understand the net capital returns accruing to homeowners, we need to adjust the gross market appreciation of something like the HPI index for depreciation, maintenance, and renovation costs. This is important, particularly in a rent versus own comparison, because rents reflect similar costs incurred by landlords. To make it a fair comparison, the costs need to be accounted for on the owner's side too. Quantifying these items is not so easy. Academic research that I'll link in the description finds a value between 2 and 3% as a reasonable assumption. In National Accounts data, Statistics Canada reports average maintenance and repair costs over the sample period of 0.82% as a proportion of net residential housing stock and renovation spending of 2.48%. This implies that there's something around a 3.3% average annual contribution to home values that can be attributed to costs incurred by homeowners. Across the 12 cities, my average combined maintenance and depreciation assumption is 2.66%, which is in line with academic research and Statistics Canada data. A common argument here is that people can DIY their home repairs and upgrades. I would say that doing that work instead of some other work is implicitly costing you. For example, if I had painted my house instead of making this video, the economic cost of painting my house would be huge, even if I didn't pay anything out of pocket. There's also a good chance those DIY projects are costing you more than you realize. I have watched seasoned tradespeople undo DIY work in order to do it properly, and it's often a lot harder and more costly than if it had been done properly to begin with. For financing, the owner in the model takes out a 25-year mortgage on a 5-year fixed term at the prevailing mortgage rate at that time. For the full period analysis, the mortgage is renewed every 5 years at the relevant mortgage rates. Property tax rates are based on the historical property tax rates for each city. These were hand collected from municipal websites or by contacting the municipality if it was not available online. Transaction costs in the model are 2% of the value of the property at purchase and 6% at sale. This includes things like real estate commissions, legal costs, and other things like staging costs. Changing some of these assumptions can make a big difference. For example, if I set investment fees to 1%, common for an actively managed fund instead of the 0.25% representative of an index fund, the average renter to owner wealth ratio drops to 1.02 at the end of the sample. Accounting for the behavior of investors who often buy stocks when they're high and either sell or stop buying when they're low could have a similar or even more severe effect. If the renter saves 80% of the cash flow cost difference between renting and owning instead of 100%, the average wealth ratio drops to 0.93. The sensitivity of the results to those assumptions and the fact that many Canadians do have low financial literacy and do invest in high-fee actively managed mutual funds or individual stocks does make me think that owning a home may make sense for a lot of people. It's probably easier for many people to buy a home and make their mortgage payments than it is for them to be disciplined savers, build a low-cost, diversified portfolio of stocks, and stick with their investments through good times and bad. However, you finance nerds watching this 20-minute, admittedly technical video on renting versus owning are not most people. Thanks for watching. I'm Ben Felix, Chief Investment Officer at PWL Capital. If you are struggling with a rent versus own decision for housing in Canada, the financial planners at PWL Capital can help. You can book a meeting with us below.